Hello, everyone, and welcome to our UK SaaS market update. And I'm Alexis Scorer. I'm a director at our GP Bullhound office based out of London. Great to see so many familiar names joining us today, and to have investors as well as founders and CEOs with us this afternoon. So with me for today's session is my colleague John Cantwell, who's a partner heading up our software team and joins us from San Francisco to take us through perspectives on the SaaS sector for Q1. Also with me today is my colleague Javed, who joins us from Manchester office to provide a quick update on recent deal activity here in the UK, including some of the strong momentum in M&A, which is in stark contrast to the same time last year when we held our last UK SaaS briefing, which I know many of you joined. We're also delighted to be joined this afternoon by serial entrepreneur Lindsay Willott to talk about bootstrapping and scaling and exiting a SaaS business. Quick reminder, any of you can submit questions during the presentations using the Q&A button that you'll find here at the bottom of the screen, and we will do our best to cover as many of these as we can throughout the sessions. So with that, I'd like to hand over to our first speaker, my colleague, John Cantwell. John, over to you.
Thanks, Alexi, and good to be with everyone here. Thanks for joining. So we wanted to start with giving some perspectives on the software market in general and things we've been seeing out there. We talk to a lot of CEOs and a lot of investors on a day-to-day basis, both in the U.S. and in Europe, and specifically with some thoughts here from what we're hearing in the UK. And this is these are a few pages from our Q1 market report that we just sent out about a week ago. But trends we're really hearing about in the space right now. And from top to bottom, we start with beacon technology being very prevalent across a few different industries such as retail, education, transportation. This is a market we think will grow significantly, and even more industries will start to adopt beacon technology. So something we think will continue to get some early funding and could lead to pretty big companies over time. I think secondly, we say the SaaS bloat gets bulldozed. So organizations are looking for ways to manage fairly complex tech stacks, and enterprises are now recognizing the importance of effective SaaS management. We actually did a deal in this space in Q1 where we sold a company called CleanShelf to LeanIX, and that was around this trend of managing your software spend, managing your applications. As there's more and more software being used by businesses and consumers today. Thirdly, SME becomes digital via HR software. Another area we have personally spent a ton of time in terms of our software practice. And what we're seeing is core HR software is being implemented not only at big enterprises, but at small organizations as well, to help manage people, to help onboard, to interview, to do payroll, to do performance reviews. Even companies that are 10 people of size are starting to use more and more HR software. And I think everything from software suites to point solutions. Onboarding differentiation, we've seen increased competition here, meaning a focus on finding new ways to differentiate, differentiate your experience. So from an onboarding standpoint, again, kind of playing off of the HR trend, this is more with respect to onboarding new customers, so customer success areas, and then being able to retain those clients and have them keep using your software. We see retention and net revenue retention be one of the biggest metrics that are kind of plays into valuation right now in the space. Fourthly, micro SaaS. So we've seen a big focus here on lean teams, lower cost, developers using a single specialized platform or a small set of specialized tools. So there was a big trend 2-3 years ago around going to suites, and now we're seeing micro SaaS come back, as pretty interesting point solutions are now available in the market. We've seen this across different departments, whether it be the developer space, marketing, sales, HR, and infrastructure software as well. And then finally, in the marketing space, we're seeing a ton of consolidation. We have Lindsay on from Customer Experience, Customer Thermometer, which is in the customer experience space, and we still do Exclaimer and Insight Partners. That was an example, but a good amount of consolidation and businesses combining in the marketing space, which is very fragmented in general and kind of ripe for M&A. So those would be the key trends we're seeing right now in the market, again, across Europe, specifically in the UK and also in the US. If we can go to the next slide. Here we have a good backdrop of valuations, and we track about 75 public software companies and kind of how they trade from a market cap standpoint. You can see over the last 5 years, there's been a steady increase in valuations in the software space. And I think as COVID hit about 15 months ago or so, we now can appreciate that software companies are more valuable than anyone ever thought pre-COVID. And you can see that here in the data. Although I think over the last couple of weeks, there's been some focus on more macro trends like inflation and interest rates. And the tech stocks in general have come down a bit, but still trading at very high and healthy levels. As a whole, you see here, the software companies are trading at 14.7 times trailing revenues, which is 34% greater than the 5-year average, and then 11.6x forward revenues, which is 28% greater than the 5-year average. So still healthy times and good times to be looking at, either exits or raising capital or IPOs. If we can go to the next slide. Here, a small sample of deals that we've highlighted. On the left, you have strategic M&A deals. And then on the right, we have fundraisers, typically large capital raises. So a lot of good deals to highlight. I don't think we need to go into detail, but these span from prop tech, where Zillow did a deal, to HR, where you see Planday getting acquired by Xero. And then also on the right, big funds like Sequoia, Tiger, Global, Insight, Silver Lake, Meritech continue to be really active in the software space and putting capital to work. I'd say that the valuations on the private side are actually a bit higher than on the M&A side right now, but not for full exits, more for just marking companies to high valuations and minority deals. So a ton of money flowing into the software space, and I think we're seeing that being driven by growth equity, private equity, but also strategic takeouts as well. And then with respect to the IPO landscape, we are seeing companies go public quite a bit. Here's companies that listed in Q1. We have companies coming up in Q2 like UiPath, Sprinklr, Instacart. Qualtrics had a successful IPO after being spun out of SAP, and then SEMrush in the SEO marketing space as well. A bit of a services and software company, but they went out in March and did fairly well. So we think this will continue to be a robust path to getting companies public. Obviously, the SPAC market is something that we're paying attention to as well, but it's starting to, at least in the U.S., slow down a little bit, and companies are reconsidering the traditional IPO path as the right alternative. Okay, move to the next slide. So I mentioned net revenue retention, or net dollar, net pound retention, if you will. A very important metric, I think, second to growth right now in the software space. And you can see how a few public companies fare in this category. Snowflake, Unity, Twilio, really at exceptional levels above 135%. We think best in class is sort of that 120% and above. Now, the details matter in terms of, do you have more of an SME customer base like HubSpot? They do, but they're still at 102%. And you typically see some more churn in smaller customers, so that can weigh you down a bit. And then also, what type of software product you're selling. Marketing companies, again, will have a bit more churn than kind of core, say, security or infrastructure software companies. But I think Slack's a great example of one that started at the SME level, has kind of expanded into enterprise, and has very much best-in-class metrics at 125% for net retention. Now, this also plays into, we sort of took the traditional Rule of 40 analysis and added in retention. So we came up with a GP Bullhound SaaS score. Again, revenue growth plus free cash flow margin plus net retention kind of gives you a total score. And you can see, in general, the companies that have a higher SaaS score here are trading at higher revenue multiples. And you can kind of map this to your own business if you like. But pretty high revenue multiples for companies like Twilio, Unity, Datadog, of course, Snowflake, companies that are kind of hitting all three of these metrics and benefiting from that in the public markets. And then back to the traditional Rule of 40 here. The companies in yellow have achieved that Rule of 40. These are all their tickers. If we go to the next slide, you can actually see how they trade with respect to that on the y-axis here, where we have the revenue multiple. And the data is a little sporadic and typically is, but you can see in general, Rule of 40 companies are trading higher than their peers that are not. And a good chunk of these businesses are still burning money, so they may be growing 60%, but losing 10% on the bottom line. Or we have seen a trend more towards break-even profitable businesses. So you could be at, say, 40% growth for a large public company and right at break-even, and you're achieving this. Next slide. Yeah, and then finally, some of the work we've done here. We mentioned Customer Thermometer. We have Lindsay on the panel here. We've also sold companies recently to Meltwater and Clear and Linkfluence. We sold Alio to HireVue late last year in the HR space. We did a deal last year as well out of the UK called Partnerize with Excel KKR, $50 million check there. So I think a good balance of strategic M&A deals and private equity deals that we've been a part of. And then on the bottom there, our fund has become a big part of our overall business, and we now have invested in a ton of big name software companies like Slack, Unity, Tradeshift, Spotify, and a few others. So I'll maybe turn it over to Javed, who runs our Manchester office, to also give some perspectives on the region.
Yeah, great. Thank you, John, and thank you again to everyone for joining us this afternoon. Before we get into our main event with Lindsay and Alexi, I just wanted to take you through a handful of slides on market activity in the UK SaaS and the broader technology market. So just to provide some context here, we can see, at a very high level, UK GDP and economic activity and market performance since the beginning of 2020 or so. And as nobody needs reminding, we had that significant drop in GDP output during the second quarter of last year, which came back very quickly as things reopened again here in the UK, but then tailed off again as further restrictions came in. I'm sure many of you saw today that the UK economy shrank by about 1.5% in the first quarter of this year, which was due to the latest lockdown that we're in. However, due to all of the positive data around the progress of vaccinations, the Bank of England has revised its forecast upwards, such that the UK will make about 8% growth in GDP during the course of 2021. In the public markets, on the bottom left-hand side of the slide, you can see that the UK and US markets clearly had that significant drop in March of last year. But what you can also see is that the US markets recovered far more quickly than here in the UK. And I guess that was partly due to the fact that the US was broadly more open for business than we were here in the UK, but also as there's a very large number of global technology stocks sat within those indices, which performed particularly well in the second part of last year. But what you can see here in the UK markets, in the bottom two lines here in orange and green, is that we obviously had a big uptick in performance last October, November time, when the announcement of the vaccinations came out. And we've also seen a steady rise during the first half of this year so far, as all of the data around vaccinations and COVID cases have started to ease. In conjunction with this, we've also seen a number of high-profile IPOs come to market over the last 3 or 4 months. The most notable one, I guess, was that of Deliveroo back in April at over $10 billion. Now, that one saw a bit of volatility shortly after listing, but there are also a number of other companies which have enjoyed strong share price performance since their flotation. Just to pick a couple of those, you can see Trustpilot, the online consumer review website, listed at a $2.5 billion valuation, and that enjoyed some good post-market performance. ATG, which is an online auction platform, that raised at a valuation of £850 million, dollars even. For a moment last week, they actually achieved unicorn status. The share price ticked over $1 billion, but that quickly came back down off the back of some interest rate news. And then finally, Darktrace, which is a Cambridge-based cybersecurity firm, also listed last month, which is a fantastic outcome at $1.7 billion. We believe that this kind of IPO activity is a great sign of the strength of the UK software sector now, particularly at the larger end of the scale. And we also see how this is filtering down into the smaller scale up and growth segments of the market, which I'll touch upon on the next slide. So on this slide, we can see that M&A volumes were at an all-time high in the first quarter of 2021. And this was driven by a combination of a couple of factors, one being the access to cheap debt, which has been prevalent for a while now. There was also some concern around potential capital gains increases, which encouraged many founder-owned businesses to come to market and sell, albeit those capital gains changes haven't quite come through as yet. There was strong interest from overseas buyers who saw good value in the UK, particularly relative to valuations that are being paid for businesses in the US. And clearly business owners are capitalizing on the strong valuations that are being paid in the market, as John mentioned earlier. You'll see on the right-hand side of the slide that the majority of acquisitions were made by strategic buyers, but there were also a number of high-profile large private equity buyouts as well. And just to pick out a couple of notable transactions which took place during the period, we saw Brandwatch, which is a really cool digital media listening platform, being acquired by Cision for $450 million. Up here in the north in Leeds, Big Change Apps was acquired in the majority by Great Hill Partners, which is a great example of the sort of quality and scale of companies that are also being built outside of London. And finally, one deal which was technically announced this month, so doesn't quite fall within the data, was the acquisition of Reward Gateway, which is a brand that I'm sure many of you have heard of in the global HR software and employee engagement space. Moving on to the UK funding activity in the software space. Just looking at the number of rounds that took place in the UK over the last year or so, you'll see that deal volumes have remained broadly consistent over the last year and slightly lower than 2019. However, we believe that's due to a couple of reasons. One is obviously that COVID halted deal activity during the second quarter of last year. But then we did see volumes recover during the second half of the year. But as a result, investors were more selective in which opportunities they were investing in, particularly as the majority, if not all of the due diligence had to be conducted remotely. And finally, if we were to replace this chart with the quantum of funds raised over the same period rather than the number of transactions, you would actually see a significant increase during the second half of 2020, with Q1 of 2021 reaching record levels at over $1.8 billion. I think this is another clear demonstration of investors' focus on high quality assets and their conviction to back these businesses with far larger funding rounds as companies look to accelerate their growth as the lockdowns are eased around the world. Secondly, this is further demonstrated by the fact that on the right-hand side of the slide here, you can see that the largest proportion of funding rounds were those of later stage VC and growth equity investors who are focused typically on more robust businesses, which will more likely than not have proven their go-to-market strategy and their resilience through the pandemic. Some of the notable funding rounds during the quarter were obviously Tiger Global's investment into Checkout.com, which is the London-based payment software company. Get, which was originally a ride-hailing service, a bit like Uber and Lyft, but it's now more focused on ground transportation services for corporate clients. They raised 115 million from Penn Capital. And then I couldn't finish this segment of the webinar without mentioning the $100 million funding round led by Lightspeed into Matillion, which is a cloud-native data integration platform based just down the road here from me in Manchester. So in summary, before I hand over, we believe that the UK software market has taken a significant leap forward over the past year or two. We've seen some very significant exits during that time. And as a result, more and more capital is pouring into the space at the smaller end of the scale, which will only breed future success going forward. We know that there's a huge amount of deal activity in the market at the moment as valuations remain strong. And we expect and hope this to continue over the short to medium term in particular. So thank you all for listening, and I will now hand over to Alexis.
Thank you, Javed. Great to see all that strong momentum in Q1, particularly those 50, 100 million plus growth rounds being closed early in the year. So I'm excited to introduce our guest, Lindsay Willott, who's joining us from the Cotswolds. Lindsay is the founder of Customer Thermometer, an award-winning survey software business that she started at home and today delivers 5 million surveys a year with over a couple of thousand global clients, including some very large global brands. Lindsay, great to have you with us. Thanks for joining us today.
Great to be here. Thank you for having me in our virtual fire.
Yeah. So I wanted to start by asking about your path to becoming an entrepreneur, Lindsay, because I understand that your first business was not a software business. Tell us a little bit about your background and the genesis of Customer Thermometer.
Yeah, no, it probably wasn't, if there is a typical route, it probably wasn't one. So I have been in tech my entire career. So I started off literally writing, after I graduated, writing brochures for the local software company, which was an on-prem CRM company. So I've always been in the kind of customer software space. And that company, did very well. I became a global head of Marcoms there very quickly. But at the age of 24, that company ever so slightly outlasted the dot-com bubble and then had some issues of its own and made an awful lot of people redundant. So I took that opportunity to really step away with a couple of other people and start a tech marketing agency, because I think we'd seen what was going on in the world. We'd seen, even probably sitting in the CRM company, bizarrely, I'd seen that a lot of marketers weren't really reaching out for customer data. They weren't really understanding how customers felt about the tech. There was quite a big divide. So set up a B2B agency called The Marketing Practice, which I'm delighted to say is still, going and strong today. And over the course of that time, I ran that business, co-founded it for about 7 or 8 years. We saw a lot of very big clients, the sort of Microsofts of this world, and looked at their campaigns, what they were doing, how they were going to market. And I think, one of the things I saw in campaign after campaign back then, this was 2002, I think I founded this business. And over the course of that decade, I realized as people were putting campaigns together, they weren't necessarily getting any customer data. So they would think very hard about how to generate new leads or how to go to market. But a lot of the customer surveys were maybe sitting on the shelf. They were just gathering dust. They weren't very actionable. They weren't very real time. The marketers themselves weren't using it. And so I think that lodged in my brain. And then the other big part of it was I saw that it made a huge difference to how long we kept a customer. So essentially, lifetime value. Even in a services, marketing industry, we could deliver a product, which might be, a new website or a campaign. But the service wraparound that went with that was critical to how well it sat with the customer and whether we kept them in the long term. And I found that fascinating. And I wanted to know on a more regular basis than annually, how can we know if the service wraparound of what we're delivering is good enough? How can we know if it's not just the product, but the service? So the concept for Customer Thermometer really came from there. And I think because, absolutely still a tech marketer through and through, not a technical founder in any way, the curiosity piece around, how do we understand more regularly how customers feel? Bear in mind, it was 2010 I launched Customer Thermometer, or 2011. So the first iPhone came out in 2010, I think. People were still doing, very long form-based surveys, essentially a digitized paper process to get customer feedback, the digital equivalent of standing there with a clipboard and asking people questions once a year. So the idea really came from there, because I was fascinated with that juncture of marketing and customer success. And I think it's something that John referred to earlier. You can't, because of things like Trustpilot, you can't have now, I think, a poor product. You can't have, you can't market ahead of reality. That was absolutely a phrase when I first started my career, that you could market ahead of reality. I think that's a lot harder now. And then if you lump in the whole subscription economy thing that was happening at the time, Salesforce was very new. I was looking at that as an ex-on-prem software head, thinking that's an interesting model. So it came from there really. And it started very much because I'd been around websites and email marketing, and I understood things like Campaign Monitor and those sorts of things. And we put what really was an MVP together, and sort of almost, well, literally tucked it under our arm and went out to see people with it to see if it would strike a chord. And it did, probably not in the ways I expected it to on day one at all, but that was where the sort of the genesis came from, really. It was that core of marketing, the core of customer insight and real-time data, and that desperation really to want to know how we were doing. And so CT was born from there, really.
And tell me, Lindsay, having run a marketing agency and grown that, how did you find that initial period of launching a software business? Obviously, very different set of challenges. It's particularly in those first few years, what did you find most challenging from going from having run a marketing agency services business to a full SaaS business?
Yeah, the hardest thing was probably, in an agency, you can, when you have dozens and dozens of people, almost say yes to a piece of work that comes your way and then figure out how to do it. So, if a client wanted a new website or a particular way of doing something, or, you'd be able to get it together and do a good job because you had a good proposition development, and then it was execution. I think, and I'm sure many people who have SaaS companies, big or small, will recognize this, but even when you've got a small handful of customers, the number of ideas that they have in terms of what they'd like to do to your software is quite significant. Say can you make it do this? Can it integrate with that? What if it did this? How about that? Can you change the color on this thing over here? And you cannot, when you're bootstrapping anyway, and also you end up with a bit of a camel of a product if you do. That was probably a very big learning for me, was, you have to have this core of belief about what it is that your software does, to not add every feature or request that's bolted on, and yet at the same time be listening hard enough that you don't miss the cues in the market for that resonance. When I launched Customer Thermometer, my firm belief, because of where I'd come from, was that the people who bought it would be in marketing agencies. That was my initial sort of concept of the piece. And marketing agencies in the early days turned out not to be very interested, because they wanted to design this sort of thing themselves, because they had web developers and lots of designers. But what did strike a chord was, a few years down the line, a customer or a potential customer literally phoning up and saying, really like it, but can it do these things? And it just so happened that I took that call, and it just so happened that I thought, that's a really interesting way of seeing it, embedding it in things that are already going out, as opposed to our initial conception of it was that it would be a bit like a MailChimp, that it would blast things out. So it's a really tricky line to walk, but I think that was my biggest fundamental change early doors, until you've got enough data, enough customers to start running the real SaaS metrics on, was that there's an interesting line to walk between accepting customer feedback, particularly as a customer feedback company, and trying to listen for the signal in the noise with that sort of environment.
Yeah, and that's an interesting question, because I guess everyone's talking about customer experience now. Companies of all shapes and sizes are investing in CX tools. I mean, clearly it's a trend that you've been tracking for a very long time, but it's rapidly accelerated over the last year with almost, you know, every component of modern life now embracing digital channels. But as a CX tools vendor, talking to your customers about the importance of CX, what did you learn, and what was your approach to CX as a B2B SaaS business?
It was absolutely in the heart of the foundation of it. And I also think it comes from the concept of bootstrapping. And, you know, the way that I've always described it to people is to say, you know, if you were to look at our or any other similar SaaS type product, be it in CX or somewhere else, that you know, that $49 a month, that $99 a month headline price, whatever it is you charge, you know, for your MRR, it can feel like you're going through a huge number of hoops to get that $49. And if you think of it as $49, you will never go through the hoops. You won't think about customer success and customer experience in the right way. So what I always say to everyone in this space and outside of it, because I think LTV and service wrap and customer experience is everywhere now, it's not just a SaaS thing, is, you know, that $49, that $99 a month, you know, we'll multiply it by 12 and then multiply it by another 3 to 10 years, and then say, well, what happens if that person loves it so much and thinks that it's great and takes your dashboards into their team meeting, that the person sitting next to them digitally goes, that's a really nice dashboard, where'd you get that? I like that idea. And then there's the land and expand. And, you know, the cherry on the top for a business like ours is, you've then got businesses that, you know, maybe started on $49 a month and have this huge LTV, are sending out thousands of your surveys with, you know, your logo on or a link to your website, and you've got that Hotmail effect, and all of a sudden your $49 is hundreds of thousands. And I think if you think about every customer to have that potential, every customer to be that acorn, you do things very differently. You know, you start to feel like you're doing things that won't scale, but actually they will scale because the revenue's there in the potential, because, you know, it will grow to be that, and you'll have that reputation. And, you know, I always say, whether it's to our customers or to anyone else I'm helping in this world, you know, what is it really, really like to do business with your company? Not, you know, are you nice to people and do you get back to them on time? But is there anything that you do in the course of a day or a week, or, you know, your normal run of business when you're dealing with your customers, that they would mention to their partner when they go home that night as being exceptional or different? It doesn't have to be expensive, but is there something that's your experiential signature? Because in a pandemic, in a distanced world, you know, those things are really important. And so we think very hard about the non-software elements as much as we think about the software elements. And, you know, you and I have spoken before about the fact that, you know, Slack, for example, is culturally important to us. Even though we would get Teams for free as part of what we do, we stick with Slack because it has some sort of cultural piece around it, that experience of using it that goes beyond the functionality of the technology. And I think that's important to us. We've always had the opportunity to upload custom icons. We've got, you know, Glossier, the big D2C makeup brand, have these like really awesome little feedback icons. Their survey is their voice. It's not somebody else's smiley faces. So I think I would always advocate those things there about experiential signature, personality, service wrap. You know, the mile that you go around that is as important as what you do with the software, and particularly in the sorts of spaces that we're in now, have to give people a reason to stay with you and to buy into that emotionally on a digital basis is really hard. So definitely think about what things you can do. I mean, our support team's called the Ministry of Magic, you know, purely because a customer in the early days said, wow, you guys are magicians, you should call yourselves the Ministry of Magic. And we went, all right, then we will. And I can't tell you the remarkability factor that brings, you know. And, you know, yes, the support is fantastic too. The hygiene factors are there, the brilliant basics, but the magic touches that sit on top are why we get remembered and potentially why we win. And it's mentioned so much as part of and it drives culturally that customer centricity as well. So I would always advocate those things of, you know, every customer is potentially worth hundreds of thousands, even if it doesn't feel like it when you're fighting through supporting them at 2 a.m, you know.
And tell me, Lindsay, so having been through the journey of bootstrapping a business all the way to exit, are there things that you learned along the way or towards the end that you wish you'd known at the start of the journey as a SaaS founder?
Yes, I think I think I didn't probably hire people soon enough at different early parts of the journey. I think, when you run an agency, you can only grow by hiring people. And I think the excitement of the fact that you could grow without hiring people was, potentially went to my head in year 1 and 2. So I think, bringing people on sooner, particularly around the sales and marketing piece, that scale does come from people as much as it comes from technology and ad spend and SEO and all of those sorts of things. So I think there's that. I would reinforce the point on customer success. If you can keep a customer for a year rather than a month, even psychologically for you, that makes a massive difference in those times. And then I think the other thing is, understand the potential upsell within particularly B2B enterprise sooner. So I think we were definitely like, right, here's a new customer, there's the next new customer, there's the next new customer. And I think, Salesforce recently released some numbers saying that, something like 70-80% of its growth this year had come from its existing customers. And there is always more there, and particularly if you get the customer success piece right. There's a lot more to do there. I guess the other thing is, when you're new to SaaS, questioning the norms. So everyone's got the gold, silver, bronze pricing models. Everyone's got the or the per user pricing or the 30-day free trial. I would encourage people to experiment with those a little bit. We don't time limit our trial. Because we find that getting people to consume the surveys and to use them is a better metric of whether they will convert or not for us. So there isn't a time limit, but there is a usage limit. So and those things feel quite subtle, but if you just sort of take the SaaS textbook, it isn't necessarily obvious that you might do that. So I think, playing with some of those things as you scale and testing some of those things a bit outside the norm and taking some risks there, particularly now that SaaS is such a standard model, would definitely be good advice, I think.
And Lindsay, you mentioned Salesforce there, and I understand you did develop some partnerships with a number of the large software players like Salesforce and ServiceNow and Google and others. How important was that for you?
It was massively important for 2 reasons. I think one is that you have that footprint in the app stores effectively of now probably 60 or 70 major companies. And it allows, a bit like the point earlier around managing SaaS stacks. We definitely see that within many organizations that we work with, that there's a huge amount of SaaS software versus what was there before. So I think the more integrations you've got, the more you can be the glue between some of those systems and allow people to do things more easily and more effectively, then I think that's a very, very good thing. And then the other one is obviously, the key to regular customer feedback is actually making it as non-human deployed as possible, because if it relies on someone to send a survey out, they will inevitably get distracted or bored or pulled onto something else or furloughed or whatever else it is. And then it relies on those people to disseminate the survey results and then do something about it. And that's really where CX stops, is where there's a report and everyone looks at it and goes, yeah, that's bad. And then no one does anything about it. So I think making those integrations for us, both from the perspective of deploying the surveys, which is obviously why the fit with Exclaimer is phenomenal, because Outlook, Gmail, just being able to deploy across those platforms, but also being able to deploy the feedback that comes back in through things like Teams and Slack, and getting the feedback of customers in real time into the hands of people who can do something with it is game changing for the organizations that we work with. And so those, sending the surveys out, but also interpreting and disseminating the feedback that comes back, that's huge for both sides of that integration coin. So
I'm going to open this up to Q&A in a moment, Lindsay. So for all of our guests here. Please feel free to submit your questions here using the Q&A button at the bottom. But I guess a couple more questions from me, Lindsay. So, you know, the decision to run a sales process and sell a business, it's a major decision. I guess you were close to 10 years in, having founded the company early in 2010. What was the trigger for you deciding to explore options for a potential exit? How did that come about, and what was your sort of thought process?
Yeah, I don't think there was a single trigger. I think there were just a number of things that happened that joined together to make it make sense. So, you know, we had a number of approaches, and they increased in velocity towards the point of going to market. And, you know, I think we needed guidance and support around those. So hence, you know, the relationship with Bullhound. You know, I think the other thing is the integration platform play that we talked about before. You know, it's very clear to us that one of the things that really helps our customers with adoption is making the rollout of this as easy and as pain-free as possible. And one of the main ways that they want to deploy this sort of service is via Outlook and via Gmail. And often, you know, CX rollouts can be notoriously painful. They can be very hard in a pandemic to get people on board, get them to use the software. And the beauty of the joint proposition is that it just happens, you know, it just appears within people's email. Nobody has to do anything other than centrally. So, you know, I think that then gives you a global footprint very quickly into, you know, the user bases of Gmail and Outlook. And those things joined together, just, it made total sense really that there was a next stage on for the business and its reach and its rollout and its global capability, and also where I think the market's going from a feedback perspective, that it was a no-brainer to look for, you know, that sort of scenario for the business at that point.
Okay, so final question from me, and then I'm going to open up the Q&A, Lindsay. So how's the integration going, and what's it like now that, you know, post deal?
Yeah, no, do you know,
part of a broader team.
It's actually fantastic. You know, the due diligence process, everybody warned me would be, you know, full on, and it really was full on. And I think also because it was the lockdown, you know, there wasn't even the opportunity to go to the pub. Not that there would have been time, but you know, it was a very strange time, and I don't really remember Christmas. But you know, it was a fantastic experience. You know, you have to really understand, you know, the whole journey through this is what you, as an entrepreneur, you kind of build these companies for. So, you know, it's very exciting. And then, yeah, being on the other side is strange, isn't it? Because, you know, on day -1, you know, you're still talking, and then on day +1, you're working together. So it's a little bit like someone buying your house and then moving in together with them. It's a little bit like that. So, but it, you know, it's been fantastic and you know, welcoming and supportive and exciting, and you know, as an entrepreneur, to know that, you know, you have that next stage ready for the business that you can go forward with is, you know, a really lovely outcome for everybody. Really, it's a great home, and you know, massive thanks to the Bullhound team for helping us with that process as well.
Great to hear it's going well. So, right, with Q&A, I've got a couple here to kick things off, and don't be shy here with the questions. And you know, if you'd rather, you know, you remain anonymous, we'll just ask the questions without saying who's asked them. So, first question here, Lindsay. Did you consider during your journey raising money, and what was it that made you decide to bootstrap the business instead?
For a long time, no, we didn't. And I think it was because of the customer centricity, and because I had run an agency, and agencies run on notoriously thin margins, as soon as we got this company to the point where it was growing well, it was and continues, to be incredibly profitable. So, there was always enough money to grow it in a manageable and sensible way. I'm sure we could have gone faster if we raised. I mean, obviously that's the main reason to do that. But I think, it's only really latterly that the CX market has become as competitive as it was, and that there's more of a clear path in terms of the growth and the global opportunity now. So, it was definitely, I would go to breakfast briefings and people would always say, how much did you raise, is like the first question. And you'd always think, am I missing something here? Because we didn't. But I think, it wasn't the world I'd come from, and it felt more comfortable for me and for the business not to do that. So, it always floated around as an opportunity, but I think it had to fit, it had to fit with how we were running it and what we were doing. And I think at that sort of early growth point for us, it didn't make sense really until more recently.
So, I mean, I've got a follow-on question from that one, Lindsay. So, I mean, now that you've had an opportunity to work with, some professional, SaaS focused investors like Insight Partners in New York, like is it Farview and Living Bridge. If you were going to go through this journey again, would you bootstrap and follow the same approach, or would you try and raise some capital?
I never thought I'd hear myself say this, but I would 100% raise now. And I think that the reason I would is it is not the same as it was 10 years ago. As soon as you can get a SaaS company out there chunking in significant revenue in a market space, then someone can put money into pay-per-click to compete with you, and it's just the way it is. And it wasn't like that. When I started this, people were not searching for one-click feedback or rating software or CX journey or any of the things that they're looking for now. Then that's just been exacerbated by the pandemic, really. It's much harder with no events and no serendipity to go out and bump into somebody who's going to buy your solution. So I would 100% raise. I'd probably be very cautious with the money, but because that's me. But no, I would 100% raise, and I would enjoy that process, I think. But it's a different world out there, and I think if you can find a niche and exploit it and go for it, even the moats that people talk about are increasingly hard to get, because it's so much quicker and easier to build tech with the tools that are out there. Stripe didn't exist when I launched Customer Thermometer. So, it was tricky even to find a subscription management billing solution, and now you can't move for them. Yeah. So, I would raise and be, really focused on acquisition and LTV.
Great. So I've got another question here, and I quite like it, so I'm going to ask it. What's the kindest thing that anyone did for you along your journey of building a business?
Oh my goodness. There's been a huge amount of kindness and sort of karma and trying to help people, whatever advice they've needed along the way. One of the kindest things I think that anyone did was actually to buy it when they weren't sure exactly, and like literally face to face. A client who's still with us now called Allen Associates, the massive recruiter in Oxfordshire. I knew Kate Allen, who ran it, and I went and sat with her and just went, what do you think of this? And she went, it's great idea, I'll buy it. Now she really can't possibly have known whether it was a good idea or not, but she bought it and she used it and she gave us great feedback, and she's been a customer for 9 years, and has sent it to goodness knows how many businesses to follow up on recruits that they've placed. So I think you really do have to go out and ask for the sale to find out if you've got a viable solution or not. You have to sit in front of someone, even if it's digital, and say, not would you buy it, but please buy it. Because if you say, would you buy it, everyone nods because they want to make you happy. But if you say, please buy it, right now, put your credit card into that box and sign up for it, that's when the rubber hits the road of whether you've really got something people will buy or not. So, but, it's a great question, and the kindness of, the team and the suppliers and, literally all of our customers supporting us along the way. There's been, I've been really very fortunate to have a huge amount of kindness, actually.
Great to hear. So final question from me, I guess. So, you're obviously committed to Customer Thermometer for the near term, but could you see the possibility of a startup number 3 at some point in the future on the horizon? Maybe it's a bit of an unfair question.
Yeah, I think, you know what, there's always opportunity for startup number 3, 4, 5, 6, 7. I think, you end up, not so much having a career as this being an entrepreneur being something that you love, and creating great businesses being something that you love. But, that said, there's a huge part of wanting to realize the potential of a business that you've created. And I think, the scaling opportunity that we now have, and the excitement around that, and the fact that there's so much, for the first time in my SaaS career, so much great support, advice, experts in the area with our amazing team that we've now, got as part of the investors. I want to know what that looks like, and learn every lesson, and really grow CT to the sort of potential that it can get to. So, although it's like a never say never, isn't it? It's a politician's answer. I'm really excited about what we're doing now, and I'm learning so much about, how, and we're all learning. I mean, the SaaS market, it couldn't be changing much faster than it is, could it? So there's a huge amount to get on with.
Well, Lindsay, thank you so much for taking the time to share your experiences with us this afternoon. It's been great having you with us. And I think that just leaves enough time for me to also thank all of you, all of the investors and entrepreneurs who've joined us from around the UK. If anyone has any follow-up questions, you can contact me or anyone on the team directly via email. We will share a recording with all the attendees after this session. And you can also download the full Q1 SaaS report from our website. See you all next time.